For most of the 20th century, Kodak was photography. In 1976, the company controlled roughly 90% of the global film market and 85% of the camera market. Few firms have ever been that dominant. Yet, in 2012, Kodak filed for Chapter 11 bankruptcy. What makes this case interesting is that Kodak did not fail because it ignored digital photography. In fact, Kodak engineers developed one of the first digital camera prototypes as early as 1975. The core question, then, is not whether Kodak saw the disruption coming, but why it still failed to adapt its strategy in time. Kodak's traditional business model was built around photographic film and film development. Cameras were often sold at low margins, while profits came from repeated purchases of film and processing. This razor and blades model generated strong and stable cash flows for decades. However, it also made Kodak highly dependent on film consumption. From the mid-1980s onward, digital imaging technologies steadily improved. Internally, Kodak knew that digital photography would eventually substitute film. Academic research shows that managers clearly understood this trajectory, but they also feared that pushing digital too aggressively would cannibalize Kodak's most profitable business. As a result, digital initiatives were often constrained by expectations rooted in the film era. During the 1990s and early 2000s, the situation worsened. Digital cameras improved rapidly, prices fell, and consumer preferences shifted decisively away from film. At the same time, competition intensified, both from Fuji in film and from electronics firms in digital imaging. Film demand did not merely fluctuate, it declined permanently. Kodak, however, still carried massive fixed costs in factories, equipment, and labor tied to film production. These commitments reduced flexibility and made strategic adjustment increasingly difficult. When film demand finally collapsed, Kodak lacked the time and financial space to complete its transition. To analyze this situation, we apply Harrigan and Porter's framework for declining industries. They define a declining industry as one in which demand decreases permanently rather than cyclically. Their key insight is that decline does not eliminate profitability, but redistributes it among firms, depending on how well strategy matches end-game conditions. The framework highlights two core dimensions. First is the structure of the industry during decline, shaped by factors such as the rate and predictability of decline, rivalry, and especially exit barriers. Second is the firm's relative competitive position. Combining these dimensions leads to four generic endgame strategies: leadership, niche, harvest, and divest quickly. Kodak largely behaved as if a leadership strategy would succeed. It continued heavy investment in film production, maintained large plants, and tried to remain the dominant survivor. According to Harrigan and Porter, this approach only works when decline is relatively slow and when remaining demand is stable enough to support a few profitable players. Kodak faced the opposite conditions. Decline was rapid, technologically driven, and irreversible. Exit barriers were extremely high. Under these circumstances, leadership became a strategic mismatch rather than a solution. Based on this analysis, we derive three strategic implications. First, Kodak could have adopted a harvest strategy for film much earlier, limiting new investment, reducing capacity and time, maximizing cash flows, and systematically reinvesting those funds into digital imaging. The trade-off would have been faster cannibalization and short-term revenue pressure, but it would have preserved strategic flexibility. Second, Kodak could have repositioned film as a premium niche product earlier, focusing on professionals, artists, and enthusiasts. This would have meant lower volumes but higher margins. The risk, however, is that such a niche might have been too small to absorb Kodak's fixed costs, requiring painful downsizing. Third, Kodak should have built digital imaging as a truly independent business unit with separate leadership, incentives, and investment criteria. It's important to be explicit. This recommendation does not come directly from the Harrigan and Porter model. Rather, it highlights a limitation of the framework.
Harrigan and Porter focus on managing decline within an industry, but they offer less guidance on how incumbents should simultaneously build a disruptive substitute business. Kodak shows that in technology-driven decline, firms must manage exit and innovation at the same time. In conclusion, Kodak did not fail because it lacked knowledge or technology. It failed because strategic commitment to a legacy profit model persisted while industry conditions fundamentally changed. Harrigan and Porter help explain why Kodak's chosen endgame strategy was misaligned, while the case also shows where the framework needs to be extended. Kodak remains a powerful lesson in the challenges of transformation under structural decline.